Welcome to the deep dive. Today we're wading into a topic that is foundational to India's financial stability and affects pretty much everyone.
From major corporations down to the individual paying off a home loan.
Exactly. We're talking about the incredibly complex, multi-layered framework for loan recovery.
And it's a space that's always defined by this core tension.
Right. On one hand, you have banks that urgently need to recover non-performing assets NPAs just to stay solvent.
And on the other, you have borrowers who need and deserve robust legal rights to prevent things like harassment or, arbitrary seizure of their property.
That tension is really why these recent structural updates are so vital. We're focusing today squarely on the major changes from late 2024 and through 2025.
Yep, we're diving into the fine print of the new Banking Laws Amendment Act 2025, the big shifts in the IBC, and maybe most importantly for you listening,
the updated ethical guidelines from the Reserve Bank of India. So our goal here is to be your expert guide to these new rules. We want to distill how these amendments are meant to improve speed, modernize governance, and critically, how they define and protect your rights as a borrower.
This is basically the new playbook for debt and recovery in India.
Okay, so to really understand the impact of these 2025 changes, we first have to appreciate the landscape they're built on.
That's a great point. Before all this, the Indian debt recovery system wasn't one single thing. It was this layered fortress of, 4 or 5 different legal paths?
And the path a bank takes depends entirely on the kind of loan and, maybe more importantly, the size of the debt.
It's like a triage system.
It is. So let's start with the big one. If you have a secured loan, say a home loan or a car loan, that falls under the Sarfazi Act of 2002.
And this is the mechanism that gives banks their greatest power. It's so important for you to grasp why it's so potent.
So what's the core idea behind it?
Speed. The full name is a mouthful, but what the Sarfazi Act boils down to is this. If you default on a secured loan, the bank gets the power to seize and auction off your collateral.
And here's the kicker. Without having to go to a civil court first.
Exactly. It bypasses those lengthy judicial processes that used to be a massive hurdle for banks.
That's immense power. But what if the debt is still big, but maybe it's unsecured, or the case is just more complicated?
That's where the debt recovery tribunals, or DRTs, come in. Think of them as specialized courts.
Okay.
They're designed specifically for higher value debts. We're talking those above 20 lakh rupees. They exist because the regular civil courts are just too slow, too overburdened.
So the DRT is a dedicated, faster channel.
A much faster channel to get an official recovery certificate that can then be enforced.
Right, so Sarfazi for secured assets, DRT for high-value disputes. But what about when a whole company is on the verge of collapse? You can't just seize a factory piece by piece.
No, and that's the realm of the Insolvency and Bankruptcy Code, the IBC.
A relatively recent development from 2016.
Right, and it completely reframed the conversation. The IBC's main focus isn't just recovery, it's resolution. It tries to find a way to restructure the debt, maybe find a new buyer, and keep the company running.
So liquidation is the last resort.
Only the last resort. It's really the highest level of systemic financial cleanup we have.
And then on the complete opposite end of the spectrum, what about all the small loans? The ones under 20 lakhs, where you just need a quick, simple solution.
That's usually handled by the Lok Adalat or the People's Court.
Which is more about negotiation, right?
Exactly. It's about compromise. It operates outside the formal court system, so it's low cost, less adversarial, and just a practical way to settle huge volumes of small-ticket NPAs.
Okay, so that's our baseline, a very specialized ecosystem. Now let's pivot to 2025 and see how the rules have fundamentally shifted on governance, ethics, and efficiency.
And this is so crucial because these reforms weren't just small tweaks. They were designed to fix some pretty glaring weaknesses. Let's start with governance and the Banking Laws Amendment Act.
Now, this might sound a bit dry, but the changes here actually say a lot about how regulators view corporate responsibility today.
They do. One of the biggest changes is around the definition of having a substantial interest in a company.
A term that's critical for transparency and, avoiding conflicts of interest.
And the threshold for what counts as substantial was just increased dramatically.
And when you say dramatically, we mean it went from 5 lakh rupees to 2 crore rupees.
A 40-fold increase.
So what does that signal?
It signals a long overdue modernization. I mean, the old 5 lakh threshold was functionally obsolete. With inflation, almost any minor shareholder could get caught in that net, creating a ton of bureaucratic noise.
So raising it to 2 crore lets regulators focus their attention on people with a genuinely material stake in a company.
It focuses governance where the real risk is.
Makes sense. But that same amendment also had a really practical feature aimed at simplifying things for individuals.
Yes, the changes to successive nominations.
Tell us about that.
Before, legally transferring assets after someone's death could be really rigid and cause huge headaches for families. Now, the law lets you nominate up to 4 people for your accounts.
That seems like a small detail, but it's huge for families. It means a smoother transfer of assets and liabilities, and it helps the bank settle accounts faster, too.
It's an efficiency boost, but it's wrapped in personal protection.
Okay, now let's move to the part of the reforms that I think everyone was waiting for, the part that deals with the human cost of all this.
The RBI Recovery Agent Guidelines of 2025. This is where the focus shifts completely to ethical conduct.
And I think we can all agree that for years, the industry had a problem with bad actors. The old playbook was often just aggressive.
Cure intimidation. And that's precisely what the RBI is now curbing. The first big concrete change is the time restriction.
The window for when they can contact you.
Right. Recovery agents now have a strict, non-negotiable window. They can only contact a borrower between 8 a.m. and 7 p.m.
So no more late night or super early morning calls designed to harass you.
None. It restores a basic level of peace and privacy.
And it goes even further to protect your dignity, right? There's a rule about contacting other people.
A huge one. Banks are now explicitly prohibited from contacting a borrower's friends, family, or colleagues about the debt. That whole practice of public shaming is now illegal.
Which was so damaging. It's recognizing that the debt is a private contract between the lender and the borrower, period.
Exactly. And on top of that, there's a strict ban on using muscle power, intimidation, or just, persistent high-frequency calling.
But rules are only as good as the people following them. How does the RBI make sure the agent at your door actually knows and respects these new limits?
This is the cornerstone of the whole ethical shift. Mandatory training and certification.
Meaning?
Every single recovery agent must now be formally certified by an RBI-authorized body, like the IABF. This professionalizes the entire sector.
So no more loosely affiliated aggressive contractors.
Right. And now the bank is strictly liable for that agent's actions. If the certified agent breaks the code, the bank faces serious penalties.
That's a huge shift toward professional accountability. Okay, so we've covered modern governance and mandated ethics. The third piece of the 2025 reforms tackles pure industrial efficiency.
Specifically, the notorious delays in corporate debt resolution. This is all about the IBC Amendment Bill of 2025.
And in the world of corporate finance, delays are toxic. Every day a company is in limbo, its assets lose value.
Absolutely. So these amendments are designed to shave months, even years, off the resolution timeline.
So how do they do that without cutting corners?
The key innovation here is something called dual-track bidding.
Okay, break that down for us.
Previously, the process was linear. First, you try to find a resolution plan to sell the company as a going concern. If that fails, then you can start liquidation.
Which could take ages.
Months, easily. Now with dual-track bidding, liquidation and resolution processes can happen at the same time for different assets.
Oh, interesting. So if a company has 5 divisions and 2 are clearly unviable,
you can start the liquidation process for those 2 immediately. Yeah. While you're still trying to find a buyer for the other 3. It unlocks capital so much faster.
it's the regulator acknowledging that asset value is perishable, you save what's viable, and you liquidate what isn't without waiting.
Exactly. And to force the issue, they've put immense pressure on the courts themselves. The NCLT, the National Company Law Tribunal, is now mandated to pass liquidation orders within a hard deadline.
And that deadline is
30 days.
30 days. For a judicial body to rule on a liquidation, that is a staggering commitment to speed.
It really is. It stops debtors from using procedural delays to drag things out while the assets just waste away. It's a game changer for creditor confidence.
It certainly is. Okay, that's a powerful look at the institutional changes. But let's bring it back to the individual. If you, listening, are caught in a recovery situation, especially under that powerful Sarfazi Act, what are your specific protections now?
The law makes sure there are some really important speed bumps built into the system before a bank can just seize your assets.
And the most crucial one is still that mandatory notice period, right?
Absolutely. Before a bank can take physical possession of your property under Sarfazi, they must give you a mandatory 60-day notice.
And that's non-negotiable.
Non-negotiable. And that 60-day window is vital. It gives you time to arrange other financing, to challenge the bank's claim, or to negotiate a restructuring plan. It's your regulatory breathing room.
And what if you think the bank's action is just wrong? You're not without options, right? You have a right to appeal.
Correct. You can challenge the bank's action at the Debt Recovery Appellate Tribunal, or DRI.
Yeah.
You can challenge the procedure, the amount they're claiming. Your right to appeal is a key balance to the bank's power.
And beyond the legal challenges, the new guidelines also seem to push banks to actually talk to borrowers who are in genuine trouble.
Yes, the emphasis is now on finding viable solutions, not just rushing to default. Banks are heavily encouraged to offer restructuring options proactively.
Like what, specifically?
Well, it could be a haircut, where the bank agrees to forgive a portion of the debt. Or it could be a moratorium, which is basically a temporary payment holiday to let you get your finances back in order.
And finally, there's one critical, long-standing protection that is so important for a massive part of India's economy.
This is so important it's worth repeating. Agricultural land is strictly exempt from the powers of the Sarfezi Act.
A bank cannot unilaterally seize farmland.
They cannot. They have to go through a separate civil court order. This protects farmers from the fastest, most aggressive recovery tool the banks have.
This has been a really fascinating deep dive. It's clear the regulatory framework is trying to do two complex and maybe even contradictory things at once.
It really is. On one side, you have the system becoming hyper-efficient for institutions.
Yeah.
That 30-day NCLT mandate is the ultimate example of corporate speed.
Yet at the exact same time, it's building these strong ethical walls to protect the individual borrower, with the RBI enforcing time limits, certifying agents, and banning privacy breaches.
The balance of power between institutional recovery and borrower dignity has never been more rigorously defined.
So what does this all mean for the future of finance in India?
Or it raises a really important question for you to think about. Given this simultaneous push for radical corporate speed on one hand and these powerful consumer protections on the other, will this regulatory tightrope walk affect the availability and cost of credit?
Meaning, if banks face more regulated, slower resolutions at the consumer level, even while they get hyper-fast resolutions at the corporate level.
Exactly. How might that uneven risk profile influence where they decide to lend their money in the coming years? That is the structural ripple we'll all be watching very closely.